Hi, and a very warm welcome to our latest WOA webinar. I'm delighted to be joined today by three gentlemen who will have great views and great information for you. I'm looking forward to a really good discussion today. A warm welcome to Antonio Salguero from Four Cardinal Points, and who is WOA's Learning Lab Facilitator for International Open Account Trade Finance. A warm welcome too to Igor Zaks, the President of Tensor. Welcome to you, Igor. And Lionel Taylor, MD of Trade Advisory Network. Welcome to you. Thank you for joining us for this update discussion on developments and new trends in international receivables finance. We'll be having a wide-ranging discussion today. I think it's something like 2,500 years ago that the Greek philosopher Heraclitus first stated that the only constant in life is change, and I think that's probably now true as ever much it was. We've of course seen a huge ongoing disruptive influence in the global economy over the last few months with COVID, its effect on demand, supply, on supply chains, the interventions of government, the reactions of markets, suppliers and users. And all of this taking place in the context of a rapidly changing environment with increasing digitization, evolution of things like AI and greater interconnectivity. So really the debate today is looking at all this and thinking, what does this all mean for receivables finance world and for those operating in it? If you do have questions in our audience, thank you for joining us. And we've got an hour today, so we'll be talking probably about 45 minutes. So there'll be good opportunity for you to ask questions. If the question is relevant to the topic of the conversation at the time, perhaps we'll deal with it then. Otherwise, if it's a standalone question, we'll look to leave it to the end. So, but either way, we'll try and answer everybody's questions. So welcome, and delighted to introduce this session. And Antonio, can I pass the baton over to you?
Thank you, John. Welcome everyone at the audience, and welcome again to our guest speakers today, Igor Zaks and Lionel Taylor. Thanks all for joining us today, and it's a great pleasure to be here with you all. Our guest selected 6 topics for discussion today, which we are trying to follow one by one, even if this is not closed compartments and there are some possible overlaps or natural overlaps between each bullet point. But the 6 topics selected for discussion today were credit insurance, what current and future role in receivables finance, technology, how digitization and AI may or may not affect the industry in the future, changing trade flows, what impact on the receivables finance market, governmental stimulus, what impacts, and the Green Seal saga, what lessons are receivables a relatively safe asset class, what lessons should funds and new entrants into the market learn when looking to acquire such assets, and finally, risk management, what changes post-COVID. As John mentioned before, please do not hesitate to make your questions because this is supposed to be an interactive session. John, as he said, will be managing your questions. And so let's start because I know that our time will be short. And if I'm allowed, I would start by you, Igor, regarding the first point about credit insurance. Trade credit insurance has been used for a long time as an important risk mitigation tool. In the case of receivables finance, we have assisted in the last decade to a growing use of this tool and to a sharp increase in non-recourse offers, most of them backed by credit insurance, allowing sometimes to decrease cost of capital and the Basel requirements and the off-balance sheet treatment at invoice financing by corporates. What is the current and future role of credit insurance in receivables finance?
Sure. Okay, so and again, credit insurance came under a lot of spotlight now with all the different recent events. But the first thing, let's just be very, very clear what is credit insurance and what it's covering and what it's for. Because the credit insurance is covering risk of non-payment by a buyer in case of a valid invoice. So it doesn't cover performance risk, it doesn't cover fraud, it doesn't cover a lot of other things. It's covering the issue of a non-payment on a valid invoice. And if it is used correctly, i.e. there are good controls over these other risks, this provides extremely valid enhancement and can be used in a lot of structuring. So, for example, it was used in some of the supply chain finance structures. I'm saying about properly structured supply chain finance, as opposed to, some odd cases we will discuss later, when you actually have a buyer confirmation, so there is no dispute, and therefore it's even more valid. Now, the insurance itself, there is also two advantages that insurers have as people come into this market. One, there are very few of remaining global players. So some of the banks used to be global. Most of them are less global now than they used to be. Most of them cannot take risks worldwide. So the good thing with the credit insurance, at least with the major ones, is you get effectively one entity that is able to take credit worldwide. And that plays a very good role in a crisis when you cannot be physical in a lot of these places. You cannot go with your suitcase to do it. And that's a very good addition. But also it's common with the risk. So obviously, if you cannot control the performance risk and you rely on insurance and you think you just provide substitution without having other controls, we get an issue. And we'll go back to Greensill case, but the Greensill case, in my view, is a gap between what investors thought was covered by insurance and what was actually covered. So we obviously need to have the right controls. But if used correctly, it's a great tool. And with a lot of support also at the government level and other coming through a crisis, it's actually performed quite well. So what we saw some fluctuations and we have some reductions of cover, but we saw nowhere near to what we saw in 2008. We saw nowhere near to what we saw in the dot-com crisis if we specifically look at technology sector in terms of withdrawal of cover and things like it. So overall, I would say the sector performed quite well and support the economy in a very good way.
Yeah, I guess we learned something with 2008 experience, okay, and the problems that we had in the past. And I guess another point is the need to be insured is to comply with the terms of the policy, which is basic. There are procedures to comply. And if you don't comply with them, of course, credit insurance will be out. Lionel, can we hear your points, please?
Yeah, well, I did agree before this. First of all, hello, everyone, that I would just agree with everything Igor says, and that's it. But I do agree with Igor. And I think also, Antonio, with what you've just said, you have to understand the policy.
Yeah,
it's around trade credit. It's credit insurance, and I don't know the percentage, but 99% of credit insurance policies work very effectively, and they will continue to do so. But of course, we always hear about the issues and the problems because of the losses that somebody somewhere will take. And I think, and I know we're going to come on to Greensill later, and Igor mentioned it. For me, one of the interesting aspects is that if you're a funder and you're relying on credit insurance, but you're not managing the policy is being managed and controlled elsewhere. And of course, with some of these structures, the funders are, quite far away from the transaction, then you've got no idea whether that policy is valid or not. And if you're actually sitting there and you're totally reliant upon that policy for your exit, then you've got a problem. And I think we saw some of that with, dare I say it, those funds involved with Greensill, who are in dispute now. But also, it's trade credit. And if you're going to provide a client with a loan, that's not covered by credit insurance. It's there to cover transactions, and I think that there are lessons for everyone to learn. And you know, so I see credit insurers as being quite an important ingredient into our future receivables financing. But also I feel a need for the credit insurers to adapt and adjust as we come out of the pandemic, something none of us have ever experienced before. We're going to have weakened companies, hopefully with increasingly full order books, looking for finance, and there is a need to insure them with maybe weakened balance sheets. So it might be, or I think it will be, that we need the underwriting elements of the insurers to start taking into account the rebuild and not just work on historical information.
Yes, I completely agree with you, because sometimes what one can see is that there are some business that they rely almost absolutely in the credit insurance policy. If they get the limits, they consider they are covered. But we know it's not like that. They need to know what's exactly the terms of the policy. And they need to know also the company which is covered, okay? Because, for example, something which was happening years ago, if you are covering the risk for a group company, the company will pull out. So you need to check. You need to do some work to see if it is part of the cover or not, okay? But let's go and for the second question, which is about technology. I think there is a revolution ongoing, I would say. It's, for me at least, it's very difficult to get aware of everything which is happening. But we are focused on the specific points and very important ones of the digitization and AI. So the question, and this time for Lionel, it would be, how do you think digitization and AI will transform or not the receivables finance industry?
Okay, I think if we begin with digitization, that's going to happen, that's happening. And that doesn't, you know, that doesn't, it's not just about the receivables finance industry, it's the way the world is moving. And all of us in our private lives are becoming more and more confident. Well, I'm not that confident, but others are confident around digitization. We're getting used to it, and our clients are getting used to it. And to be honest, a lot of the, I think, quite interesting developments that are taking place are really there to prepare our sector to be able to handle our future clients. And our clients are going to expect the way that we communicate, the way that we pass information to each other, you know, it's going to be on the basis that everything is digitized, you know. And of course, what we've seen a number of consortia around various aspects of trade finance, groups getting together to collaborate in a more digitized world, mainly in the world of trade finance. We're seeing laws starting to be reviewed and changed. I think most of the audience will know that in the UK, it's expected that a new bill will be out in 2022, which updates, I think, the Bill of Exchange Act of what is it, 1882. So, you know, the whole world is moving towards a more digitized state, and we as an industry are being carried forward as part of that. So I don't think there's a choice. I think this is the way the world's going to be. And the question then is, how do we use those tools, and AI is part of those tools, to enhance our current offerings and our future offerings? And the, you know, digitization makes it a lot easier for information to be shared, to be communicated in a more instant basis, which hopefully will lead to better controls and lending decisions. AI is something I think that's very useful in terms of, dare I say, prediction, in terms of spotting things. Again, I'll hark back briefly to Greensill, where there was a talk about future receivables. Now, I think the way that Greensill operated was an abuse of a future receivable, and I'm sure we'll go into that in more depth later, so I won't say anything more now. But there is that concept that if you have AI and you have the tools and you have the ability to look at your client or potential client and take out lots of information and do various, using AI, doing various predictive things, you possibly can do more lending than you have done today on a slightly different basis. So I think all these things are going to come into our sector, although I still believe the human touch is going to be important, because at the end of the day, digitization, AI can help with lots of things, but you still want a human at the end of it, in my view.
Yes, of course. Great news. Higer, can we hear your opinion, please?
Sure. No, I mean, same as Lionel, would agree with most of the stuff Lionel was talking about. I will, however, just highlight there are things that we are talking about and that are making a real difference, and there are things that have potential, but there are some requirements for this to happen. So if we are looking about digitalization basis, like getting a proper platform, digitalizing documents, creating, some of the common standards for a lot of these documents. These things happen now, these things have an impact. There are two technologies that, in my view, had a massive potential, but also have a lot of barriers for implementation. One is a blockchain and one is AI. With blockchain, the biggest issue we have is what's named a network effect. And this is basically what happened, that if everybody is going to go on this type of platform, you have a massive advantage and everybody wins. So if you can track the goods all the way through and you have the freight forwarders and custom agents and inspections and everybody on a common platform, that will have a big impact. And there are places when the governments are moving this direction. For example, Singapore, when people are effectively forcing some sort of blockchain-based networks to be used by multiple players. But if it's only used by a couple, then we saw it with previous technologies. We saw it, for example, with regional Balera. We saw it with many others, that you create this sort of great idea, but if not enough people picking up, then it doesn't have this impact. So I would say it's a massive potential, but there is like this push that is needed for this to start making difference. Now with AI, it's a different type of problem. And with AI, there are, in my view, two types of problems. One is this famous saying that if something is written in Python, it's probably machine learning. If it's written in PowerPoint, it's probably AI. People are using the word AI for a lot of things. In many cases, you look behind it. It's people are using, 10 data points in linear regression. So we just need to make sure we understand when people are using it, that it's not effectively a random sort of decision being smokescreen by a scientific term. And that's very important. The other thing, if we are looking at AI, it's all about the data, garbage in, garbage out. So it requires clean data, and data cleaning is a big issue. It's also required enough events to calibrate it, because you only have two technologies. You have either supervised learning, when you need to have expert decisions on which you can actually train the system, or unsupervised learning when you have actual events. So if you look, for example, at defaults and you look in a larger companies, the number of events is very, very small. It doesn't happen every day that, a large company is going bust. It happens, but it's not many events. So if you get a system trained by this small number of events, if you, for example, train a self-driving car, you get millions of events in a very short period of time. Somebody driving, somebody walking, all the time events happen, all the time the system is learning. Credit, unfortunately, the same thing with medicine, by the way, people don't die that often. So when you make a diagnostic system, again, if you are training it on survival as opposed to, a symptom, it's very, very difficult to train the system well. But this is a type of thing. So when you start looking in a technical terms, you just start looking, and very often you see that people are claiming use of technology, and you don't even need to dig into technology. There is no data on which the system can be trained. So people are claiming it's actually done using AI. It's probably not correct. I'm saying about, fundamental decision making, where AI makes a massive difference already, is in a more practical thing. So if you need to convert a paper document to an electronic document, for sure, AI can add a lot of additional functionality to optical character recognition. You have natural language processing, you can do a lot, and that's where it's used. It's using some of the fraud prevention. So there are areas when it's working already. There are areas when people are talking about it. But in each of these cases, you really need to dig. And Greenhill example is a good example when people claim there were a lot of technology behind it and nobody sees this technology. So when the discussion starting about selling, for example, a company, it doesn't look like there was a piece of technology, at least that buyers wanted to pay for. So that's, again, to me, AI have a massive potential. We just need to filter what is the reality and what is the wishful thinking.
Can I just make a point? Because I mean, I do agree with Igor. I think we're at the beginning of a journey rather than in the middle or the end. So I think with digitization, you know, we're not going to have everybody in the same club. It's just impractical, and we know that. And I think what we've seen so far is steps in a journey.
Yeah.
And I think, you know, sort of interoperable, initiatives are going on, whether it's ICC and what have you. You know, we've got various fintechs coming out with, again, other developments. One we're involved in Inigio with Trace Original, which is the concept of a digital original document. You know, there's lots going on. And I think it's at the beginning, but I think, quite frankly, the market will drive it eventually. And it might be that what we see in, I don't know how long, in 5 years' time or even 10 years' time, will look very different to what we're seeing today. But you have to start somewhere. So I think, you know, but I think you're certainly right about AI. How it's used is going to be key. And that's why I always like the idea. And I speak to a number of our clients who talk about, we don't need credit anymore. So we don't need credit people. We're going to have AI, and it's all going to be whizzy and wonderful. And and we sit there and we think, well, we're a bit older. Maybe you still need that person probably at the end of it, who's going to make a judgment call. So you don't have a situation that I read about recently, where there was a couple, this has nothing to do with receivables, it was about mortgages. A couple decided to remortgage, and actually their building society turned them down because it said you couldn't afford to repay the mortgage that you want, yet they were looking for a lesser mortgage than the one they already had, which they'd been paying perfectly. But it's back to that computer modeling and what have you. So, I think the human element will always be there.
Yeah.
And I would agree with Lionel. And one example, again, if you look from the past, was internet. Because definitely the invention of internet was a revolution. It changed completely the way we are working.
Yeah.
But a vast majority of the companies that were during the internet boom, if you are looking at .com crisis, happened to have a rubbish business model, not much thing behind it, and didn't lead to anything useful. At the same time, that was the time when Google's and Amazon's and all the real companies that make a massive difference were born. And if I will put it this time, I will say, what is the difference between Google and Alta Vista? You really need to be a very, very deep expert to understand the difference and to say why one of them will be better than other. And I think we're in a similar situation. We have definitely a revolutionary changes in technology that will actually change the world. I have no doubt about it. It doesn't really mean that we need to look at everything that has this sticker on it and say this is going to be a great company, because only a few of them will be.
Well, thank you, gentlemen. I believe that in this regard, we are still in the middle of the process for sure, and we'll have to wait some time for sure, some years to optimize and get the full potential for this technology. In the meantime, I will pass to the third topic of today, which is the changing trade flows, pandemics, geopolitics, ESG uncertainty, supply chain security concerns, continued shortages and disruptions, transport bottlenecks, increasing freight costs, components, and the increase of the prices of components and raw materials. So what will be the impact of the changing trade flows in the receivables finance market? What is going to happen?
Yeah.
I'll refer to Ivan, please.
Okay. So I don't have a crystal ball, neither do anybody else. But as Antonia mentioned, we get almost like a perfect storm of a whole bunch of factors happen at the same time affecting trade flow. So you have a geopolitical factors. So you get, for example, U.S.-Chinese relationship. You have a whole bunch of other, regional issues affecting the flows. You have COVID itself that is affecting a lot of requirements and it both affecting supply and demand. You get a lot of logistics issues that are caused now, and we get a lot of logistics providers either with increased cost or reduced performance as a result of this crisis. And as a combination of all of this, virtually every company needs to consider some changes in their supply chains. So at least some components of the supply chains are changing. What it means from point of view of trade, and the other thing, we also get less physical contact, less ability to meet face to face, more reliance on electronic systems, and this electronic systems don't even exist in many cases when we do it. So what it's going to cause from point of view of a financing, the system needs to become more agile. Because generally speaking, the historic approach that, say, for example, factoring companies were taken and majority of other finances, we rely on a long-term relationship. We have a long-term relationship, we can analyze the past and we can learn the lessons and we can predict the future. So we look there and we can detect fraud, we can detect, the patterns, we can model dilutions, we can model defaults, because we get a lot of this history. So when you have a system changing quicker than before, it's becoming more difficult. This, by the way, a big question to application of, any type of predictive model, and whether you name it AI or you use a very basic and simple models for inventory management, is that you need to get consistent history. And then you apply various tools to this history, either a computer or a human being who been there, seen all the stuff. And it's, this is our client for 20 years, we know all about them. And suddenly you have to change. So these changes require much more agility and much more ability to adjust, to manage the risk, to come with the new structures to finance it. And I think it's a risk, but it's also a great opportunity for the industry.
Yes, it's true. Lionel, your views, please.
Yeah, I mean, it's an interesting question because we were predicting with ESG and various other factors, onshoring and nearshoring will become the new in thing. Yet when I've spoken to people in the last 2 weeks who have been talking to their clients, they're saying, well, actually, no one's changed anything. And as far as they're aware, they're not looking to necessarily change anything. So, I think it takes time to change supply chains. It takes time to modify. If one looks at the investment large companies make in their suppliers in various areas of the world, things are not going to change overnight. But those running supply chains and those looking at trade flows are always looking at whether they're getting the best value through their current existing arrangements. So if freight costs are increasing, and they look at that market and they say, well, actually, we saved in labor, but now we have much higher freight costs. We might start looking at, other markets, other areas of the world, maybe closer to home, for our supply. So I think we will see some natural developments happening just simply as people look at the costs of their supply chains. I think ESG and certainly the environmental, obviously there's been a lot of impact pre-COVID as to, the whole environmental issues and the green issues and what have you, which are vitally important. And we're certainly seeing corporates are taking more interest and more note, and treasurers that I've spoken to will now say that the ESG element is an important part of their thinking as they're looking at arrangements moving forward, and I think we'll start to see some effect. How it translates to our industry, I would hope is that funders and financiers start to look at how they can encourage and better encourage, the more greener or more environmentally friendly activities with possibly, cheaper funding or more direct funding to, suppliers who meet criteria or industries that meet criteria. We're already seeing some element of discussion with some of the banks around fossil fuel financing, although I think from a trade perspective, none have yet been brave enough that I'm aware of to say we're not going to finance the main traders like the Glencores and Trafalgaras and others as yet, because they're such big income earners. I think COVID has taught us that you can't always rely on overseas markets in terms of your supply. So I do see some countries and countries starting to look onshore as to what do we need to develop to protect ourselves going forward. And obviously the PPE equipment is the obvious one that we can all look at. When COVID hit, I can't remember the percentage, I think something like 48% of all PPE was being manufactured in China. So of course, COVID hits China first. China grabs as much PPE as it can, not just from China, but from other areas of the world. And then when everyone else followed, there was a shortage of PPE. So I think we'll start to see some governments and looking at how do you protect industries that are potentially vital going forwards. But I think what we will see is gradual change. I don't think it's going to happen overnight. And I think we as funders and financiers will adapt to that change as we always do.
Yeah.
I think there has been a very clear evidence, I think, just on that point, Lionel, of a sense that supply chains have historically been driven to lowest common denominator by cost and just in time justification. I think that perhaps one of the outcomes of this is that it's just shown how over-optimized these routes can be. And as you say, there are various examples in terms of becoming a need to create greater resilience in the supply chain. I think that's one of the outcomes we're likely to see. And you say that in PPE, but also in the components for drugs. There's been real issues in terms of chip manufacture for autos, for example. So I think multiplicity of supply is certainly going to be something which comes up rather than single line transglobal chains. I think we're going to see rather more investment and resilience in supply chains as a result of this.
I mean, one thing I will add about supply chains, that optimization actually reduces agility in many of these cases. So what happened, for example, people try to minimize inventory. People try to do other tools of optimization that are all based on the data. They're based on the data in a benign environment. When we have a stockouts, why we have stockouts? Because people optimize it on a benign environment. When shock happens, it doesn't have the sufficient amount. The same thing, the switching cost, because what you want to do in a normal conditions, you want to integrate as much as you can between you and your supplier, both operational, financial. You create a whole bunch of systems that are making it working very smoothly, very optimized. At the same time, it's increasing massive switching cost. If you need to change the supplier and you have a completely integrated manufacturing system, you have very much linked financing, you have a whole bunch of different things, you got, a really sophisticated optimization involving logistics and manufacturing, and you want to change it tomorrow. It's a massive cost, it's a massive difficulty. So what was actually a very good strategy in one environment turned out to be a disaster in a different environment. And we saw it in several industries.
Well, I think, I agree, Igor, and John, I take your comment on board. I think we've seen the almost the failure in the pandemic of just in time and lean manufacturing. The challenge I think we have as human beings is we're switched onto these things today and then we forget, and we go back to what is the optimum in terms of as much profit, etc. So, but I think there are lessons to be learned. It'd be interesting to see how long we learn those lessons for.
Yes, they'll soon be forgotten, I suspect.
Yeah, great insight, in fact. So we can pass for the fourth topic, which is about the governmental stimulus, which happened massively in some countries, practically everywhere, with aid package to people, business, in some cases, by injecting huge amounts of liquidity in the economy, direct loans, credit moratorium, credit insurance support schemes, and some other stimulus. So what would be the impact of these stimulus in the market? And what happens when the government starts phasing it out? Lionel, please.
Okay. I think it's important to say that there are areas of the world where there were no packages. And in some of the developing world, where the countries couldn't afford to put in place some of the stimulus packages or the protection packages, the SME has just had to survive. And some of those SMEs have been supported through payables finance schemes where they've been fortunate to be on a program, but there are, there's a wide area of the world where unfortunately there hasn't been that support. In those countries where there has been the support, and obviously I'm sitting here in the UK, it's been the amounts are just unfathomable how much support has been out there. But the challenge, as you say, is when the money runs out. Exactly. I mean, there are two aspects to it. First of all, that money has to get paid back somehow by someone, and obviously it's taxpayers, and it's whether it's business or individuals to balance the books. So I do that's going to happen. But the aspect, to be honest, is there are a number of companies still in operation today that probably wouldn't have been without these packages of support. And talking to some of my friends in the insolvency world, they've never been so quiet because no one's going insolvent. Sometimes actually it's very difficult for someone to go insolvent in an insolvency process because the government have decreed now's not good timing. But these things are going to hit. I mean, as we come out and the government support starts to disappear, we're going to have a lot of, we're going to have companies who are weak, who maybe cannot continue, who don't have the strength to build their order books again, and they're going to fail. And that failure will cause hardship for those involved. I think there'll be some short-term challenges around the credit insurance market. Certainly the insurers I've spoken to are all anticipating that there's going to be insolvencies and claims to deal with. So I think what we've done with the stimulus packages is we've really put off what is probably going to have to happen at some point before we can move forward in the recovery. So I do see some short-term turmoil, and of course, for the companies that do start to build up their order books, they're going to need financing. They're going to need the banks and others to provide that working capital finance. And we've seen from previous downturns, and we'll call this a downturn in a way, banks are quite slow to suddenly wake up and start providing working capital finance again. They're very cautious. And if there are insolvencies, they're going to be even more cautious. So I do see some short-term turmoil, but I think it will eventually even itself out. And then hopefully we can start the recovery, at a great speed.
Yeah. Igor, can we hear your opinion about it?
I mean, the first thing I will say, and again, the best we can learn from experience. And regardless of the stimulus, there is always a time lag between the crisis and a spike of insolvency. So if you look, for example, for 2008 crisis, most of insolvencies happened around 2010. So we get about 2-year delay in terms of the peak of insolvencies. Now, if we look at the government support program, that's actually pro-cyclical in this respect, because it's also smooth and significant of what will happen now at the cost of what's going to happen later. The big difference, though, between 2008 and now, that 2008, they allow banks to have a hit and then have to bail out banks. And at this point, actually, banks so far seems to be quite protected, and a lot of the bailout happen at the level of the companies now. But what will going to happen, and I don't think we are saying a short term, I think we are not going to see peak of insolvencies right now. We will see peak of insolvencies maybe in a year, but we will get, with a delay, an impact of what happened, and that will impact a lot of different parties that are going there. So we get bailouts in terms of direct aid. We also get like excess liquidity in the system. So if you look today, and by the way, what is the reason? You get things, you get case like Greenfield. You look at a very simple underlying reason: people are hungry for yield. You get funds like your pension cannot get any returns in terms of anything that is fixed income issue. Like you get something on equity, but on fixed income, like everything is there. Like deposits are zero. You cannot. Bonds are very, very low, so you cannot really get a return, and therefore people are hungry to get. And you get like too much competition for money. You get people basically putting money in things without doing it. That's what happened in real estate bubbles. That's what happened in many other asset classes. Receivable finance is not an exception. It's just, hunger for yield. Now, at some point, we will get liquidity eventually going out of the market. We will get support going out of the market. And then the fittest survive. So then basically we are going to a stage when the investors who will do a proper due diligence and the financial institutions who do effectively high quality work, whatever you define it, will be able to take an advantage and to grow and to improve in this segment. And the ones that are not going to do too well. I mean, that's probably what we will see. And again, looking at experience, I remember again taking the dot-com crisis. So at this point, I used to work for Dell. And we get this model when we were very agile. We didn't hold a lot of inventory. We were able to, and we grew like crazy. We become #1 in the world very, very quickly, just because everybody else were stuck with a whole bunch of things they bought with the supply disappearing. And we were able to adjust. And I think it's more or less the same trend we are going to see within the financial industry on this crisis.
Yeah. Well, I guess there will have for sure some bad surprises and some turmoil. As Igor says, maybe not immediately, but in a few months or even in a year time. But this will be expected. On the other hand, well, I guess the impacts will have a strong positive impact in the economy, which will impact as well the receivables finance industry. And so I think the things will balance, because what I noticed, at least here and in many other countries, it was that the support, the governmental aids, in some cases were a little blind, okay? So they support either those that are able to continue and to survive, and they support those that don't have a minimum conditions to continue business. And so they will be out of business for sure as soon as stimulus stop, okay? As soon as the government aid stop, they will finish.
I do think, though, that there will be great opportunity for those in the sector in terms of providing working capital finance. Again, those who are more agile, possibly the non-banks, the fintechs, as long as they get their model right and they don't forget the basics, and I'm sure we'll go on to that with Greensill at some point. I think there's going to be great opportunity because they can react more quickly, to the needs, especially of smaller businesses.
And there is the other good thing, just to finish this topic, which is that the possibility for receivables finance to finance the blood of the company. So you are filling the blood pressure of each company, and it's much easier to lend based on receivables, okay, rather to make some banking loan or some current account or whatever and look at it every 6 months, because in the receivables finance, you can get the pulse of the companies and you can see how they are collecting, how they are selling, how they are doing everything. So it was a huge indicator. I remember I tried to impose it in some company, in some group, because I was offering receivables finance for restructuring operations, okay? Because the banks were there with lots of money, and I arrive and I say, look, I can finance easily 30–40% of the receivables, and you get rid immediately of 30–40% of your loans, okay? And then you will have the access to the control of the companies, okay? Because look, I get out of some businesses just because I noticed they lost his biggest client in the United States. It was an exporter here in Portugal. They lost a client that worth 40% of the sales. I simply get out, okay? It was a capital intensive business. So I get out in 60 days. The banks were stuck there and they had problems. Anyway, let's go now to, yes, please.
Yeah, if I can add one point, and again, restructuring is something I've done for many, many years, and I worked with a lot of distressed situations. And if you look at receivables in this situation, it's completely amazing what one can achieve there. Because, for example, if you're a bankrupt company and you offer credit terms, just by your supplier paying you early through any tool when the goods are accepted, they can effectively provide you financing without joining the queue of creditors. They don't need to become debtor in possession or anything else. So if you have, for example, a properly structured supply chain finance program, and you are able to pay immediately to a very distressed supplier on a good that already checked, that already there is no risk related to this good, you effectively can provide them a lifeline without actually joining the queue of creditors, without need to go into, for example, national insolvency legislation that does not allow debtor in possession type of structures. So in many, and there are like a lot of like ways you can use it. And when you start looking more at operational, or for example, you trade with a subsidiary of a group that is insolvent, but if administrators need to sell it as going concern, they're not going to stop paying suppliers. And we get this case in one of the very big bankruptcy cases when we were paid like a clock, when the parent company was basically going bust, on a simple reason that stopping supply to this subsidiary was not in the best interest of creditors. So administrator would do it. So if you start going there, there is a whole dynamic, there is a whole, practical, legal, operational issues. But there are a lot of things that a smart sort of financier can do there to actually both help the economy and make some profit.
Sure.
Yeah, I think there's also the question of the industry reputation. I mean, one of the things that I think that we've fought very hard for over the years is to be associated with success. And I think we'd have to think very carefully about being seen to be funding zombie businesses. So I think there has to be sort of a clear route forward if we get involved.
I'm not saying about zombie businesses. I'm saying about businesses that can be turned around.
Yeah, exactly.
If people are dead, they're dead. Like, you need a funeral bureau. They're not an intensive care unit.
Gentlemen, our time is flying as always, and we still have 2 topics for discussion. One is the unavoidable theme of the Green Seal saga. What lessons learned, and the question of if the receivables are still the relatively safe asset class they used to be. And what lessons should funds and new entrants into the market learn when looking to acquire such assets? Honestly, I am shocked with what happened, but what surprised me most, it was the fund management, okay? Because it's hard to understand what they are exactly managing, the fund managers, okay? And if I may, because we are approaching from the deadline, from the end of the meeting, is trying to connect this. and all the other subjects we talked before already with the topic of the credit management and what changes we will assist in the future, because everything is related, okay? And so the changes in the trade landscape and all those changes that we talked before, for sure they will impact the risk management. So as we are short of time, maybe you can put together your opinions or your comments about the Green Seal saga together with the changes in risk management and what will this imply. Please, Lionel, it's your time.
Okay. Gosh, I mean that's a whole 3 hours in itself.
Yeah, yeah, that's the problem.
I think what I've learned from Green Seal and you know, from reading the newspapers, listening to the various UK Parliament select committees, which have been absolutely riveting, is, you know, the lessons to be learned which affect credit management, etc., is, you know, is relevant for different aspects. If I was a Green Seal and I was setting up my finance business, I would want to ensure that I very clearly distinguish between my shareholders, my funders, my clients. And that, what we're learning from Green Seal seemed to be very mixed up. There was not so much differentiation. So, you know, the funding seemed to be going around, and you had the same parties playing different roles within the business. If I was running that business, it would scare me. I think the other thing that we saw, and again for any finance company, is don't put your eggs into one basket. So if you're reliant on one client, which obviously on day one you are because you start with one client, but if you don't build up a portfolio, then you're going to run into dangers. And allegedly the Gupta Group of companies, you know, represented over 50% of their portfolio. I mean, that's just dangerous and madness. Similarly, and again, whilst, you know, we learned from the select committees, there were maybe 28 insurers involved. I have to be honest, I'd love to get a list of those 28 insurers, because whenever I look at trade credit insurance, there are about 5 or 6 players maximum. But there was there was one dominated one around Tokyo Marine, and again, your business is then becoming more reliant upon that one party, whose, if policies change or make different decisions, it can badly affect your business. So I think from running a finance company, you know, there are lessons to be learned. I think if you're a fund, and you mentioned this, I mean, you've got to understand what you're marketing or what you're funding. You know, Credit Suisse, from what I understand, wasn't putting its own money in, it was putting investors' money in. So it was marketing these bonds, which were credit wrapped. But did they actually truly understand? And how, you know, and how did they monitor what was actually, you know, involved in this? You know, was it just receivable? Well, we found out it wasn't. We found out there were business loans secured by other assets, supposedly. So there's a lesson, and certainly I'm sure Igor's seeing it the same as we are in terms of funds that are speaking to us now, is they're ramping up their due diligence. They're ramping up their understanding, so they know what they're marketing or they're buying. And of course, we sit there and we think, well, shouldn't you have been doing that anyway? But people get comfortable. People get, you know, comfortable. As Igor said before, the chase for yield becomes overwhelming. So people start believing things. They don't check on things. You have big personalities. You know, Lex, you know, is a big personality. You know, with a supposedly massive success very quickly, which is sometimes a lesson in itself. People just buy into this without doing the checks and balances that they should do otherwise. So I think, you know, for me, the lesson is, if you're a finance company, look at your major pillars, look at the levers you have to push and pull for a successful business, and don't lose sight of those. If you're involved in funding, whether directly or indirectly, understand what you're funding, you know, understand the trade cycles of the clients, understand the operations of the platforms and what controls they have or do not have in place. Do that due diligence work, not just at the beginning, but also go back and check, as we in receivables finance have always done. We've always done field audits. We've always gone back to clients and checked, are things as they were when we started the relationship? You know, to me, these are basics. And I think that's, you know, something that I said it, I think on LinkedIn right at the beginning, was it looked like people had just forgotten or decided to ignore the basics.
True. Igor, can we heard your opinion about either Green Seal and risk management changes in the future?
I mean, the first principle that I will start, you know, looking at anything, if this too good to be true, it probably isn't. And you get the type of assets, you know what type of yield is doing. If you see something that is supposed to have, you know, extremely low risk and produce extremely high yield, unless you really deeply go into it and you understand that there is a genuine arbitrage, this very rarely happens. Something is wrong. Then you just need to either walk away or dig very deeply to find out what exactly is. Exactly. So what we see here, we see a couple of labels. And again, this is what I was mentioning before about people reading labels, not looking what's under them. Okay, supply chain finance, credit insurance, artificial intelligence. Great three words that all were used at different times in this saga, and neither of them seems to be accurately reflecting the reality. So supply chain finance, what's supply chain finance? It's a confirmed by receivables. Thank you to supply chain finance forums. There was a little bit of a confusion by trying to make a whole bunch of different products, you know, under the same umbrella and using the word, but generally what most of the people mean, it's a very simple, boring, and low yield product. How can you make it high yield? You either need to go to a real bad credits, or you need to go to some very different type of risk. There are only this way. Insurance. What exactly do you insure? Like if you have a multi-year program and you have an insurance that may or may not be renewed, and it's only covering the risk of this buyer not paying on a valid invoice, as I mentioned. So if supplier did not perform, it's not covered. If there is a fraud, it's not covered. If the buyer happened to go bust before even being invoiced, most of the policies will say you need to act prudently as uninsured, or will say something what you need to do to prevent losses. There will be some type, I obviously haven't seen directly the wording that was there, but most of the policies will have something to prevent what will be an abusive behavior. So again, if you look there and you look what was disclosed in discussions with both Gupta and Bluestone, there were a multi-year facility about future receivables, prospective customers, and things like it. It cannot be insured. And then you get, it's past further, you get a rating agency that nobody wants to talk about there, or that rated some of these funds. And you also get then, you know, the fund manager who probably haven't looked at. Now you look structurally, like you look at the credit insurance policy. That was one of the questions in the chat about this very question. Was the structure that was publicly mentioned by Credit Suisse was used was a loss payee. What is a loss payee? It's just you get a benefit in case of a claim. You are not party to the policy. You cannot manage it. So surprise, surprise, if things are going wrong, you are completely dependent on a party that is managing the policy, that may be insolvent and may have other interests, because at the end of the day, the duties administrator have, and looking after your interest may not necessarily be in the best interest of the creditors of the entities they appointed as administrator. So there is a whole bunch of different things that you need to look. So if you look at the lessons, the first lesson, you really need to see whether different part of a structure match, whether what you insured matching what you actually have, whether you have independence, because the whole idea of, say, of many of these programs, you have independent buyer and independent seller. So if you compare what they're saying, you come into some sort of truth. Now, if you have effective financing between two parties of the same group, you don't have this truth. Because at the end of the day, they have no separate interests. Like the idea is, if I am selling my goods, I want to be paid. If I am purchasing them, I don't want to pay for something that doesn't exist. So there is some sort of control that you do in any form of receivable finance by talking to two different parties. So to me, this whole related party issue is a complete nightmare that is immediately making the whole picture less transparent. Now, concentration, again, massive issue. And again, concentration may not necessarily be bad. Like if you look at majority of a classical supply chain finance program, they're highly concentrated. You have, say, one customer, but it's an investment grade customer, and you don't tell anybody any story except this is my AA rated customer. This is the control that actual my exposure is to this customer, and this is what I'm selling. So it's a possibility, but then it needs to be very, very clear to all the parties that this is the business there. And the biggest problem here I see is lack of transparency, because even now nobody have a clue what was inside.
Yeah. Well, we have come to the end, I guess, because there is no time, unless John allow us for some last thoughts or comments from our guests, exceptionally.
Yeah, I think we do try to keep it to time. So if
Okay.
We have a last aphorism from either guy, either of our speakers, that would be absolutely thing. I think the thing that's clear to me is one of the lessons that we've got here is about the importance of clarity of understanding and the learning that's important that comes from these events. We really do need to make sure that this understanding is widespread. But yes, allow me to let you make some closing comments, and then we'll leave it be. What's really good to know is that we've got plenty of conversation here for a future session. So thank you from me for all our speakers, and I'll just hand over to you for a couple of final words.
Okay, Igor, can you start some final comments?
Yeah, I mean, my final thought will be is that we have a great opportunity now. Like with everything that is happening, at the end of the day, quality of work, quality of due diligence, ability to be agile have more value, and that to me is important, because with all the problems, with all the difficulties we see, I personally see it as opportunity, because I see it where we get a little bit of distinction between people who create a hype and people who do the real type of analysis and real type of work, and the value. And I think overall we'll end up with a better quality players, with a better structures, with a more polished things. So I think we are all good.
Thank you.
Thanks a lot to you. Lionel, some final comments?
Yeah, I mean, I think one of the questions is receivables still a good asset class to invest in? And I think the answer is absolutely. I mean, I think we belong to a marvelous industry. Gosh, I say that after being involved in it for about 40 plus years now. It is a wonderful industry. We have a great role to play going forwards. There's always going to be the bumps in the road, but actually, certainly as we come out of the pandemic and as the world moves on, the importance of our industry to support business is really vital. So I think whilst we've all been stuck, and I can't wait to be able to travel again, and we've had to face something the world has never faced before. I think the future looks really bright, and I'm just delighted that we're all part of this sector and this industry.
Well, thanks a lot, both you, Igor and Lionel, and thank you to the audience. I hope you enjoyed this discussion. Thank you. Goodbye. And I hand it over to John for some final words as well, and to close this webinar.
Okay, well, I think we can have a double act close, so that's great, Antonio. Thank you, Igor. Thank you, Lionel. Thank you, Antonio. A great session, much enjoyed, and we'll look forward to you speaking again in the near future. Cheerio now, everybody, and thanks.
Thank you very much. Thank you all. Have a good day.
Thank you.